The largest scheme category in the actively managed equity mutual fund space is, and I know that a lot of you know this, but I'm going to spell it out. It's a sectoral and thematic category. It wasn't always the case. This is something that changed last year. It used to be the flexi cap category, but the interest that retail investors have in the sectoral and thematic category is such that it has grown to the proportions that it is at right now. And a lot of people get into these concentrated investments thinking that it's going to give them significant alpha. What we're going to try and do is find out whether this has been the case since COVID-19. And joining me now is Belapurkar, who's Director of Fund Research at Morningstar India. Kaustubh, thanks so much for taking the time. The first question, of course, is how have these schemes done since COVID-19? That's the operative question.
Yeah. Hi, Alex, and thank you so much for having me in this conversation. Very, very interesting, and I think a very timely conversation to have, because like you rightly said, the past couple of years, we've seen an immense amount of interest in sectoral thematic funds. Mind you, obviously, there are various sectors and themes within the space, but this is the largest, about 15% of the overall open-ended active equity AUM as things stand today. So that's a pretty significant chunk. And this wasn't the case a couple of years back, right? So if you just look at 2024 by itself, you had fresh inflows of about 1.55 lakh crores in sectoral thematic funds, both in existing and new fund offers, which have also been quite a few over the past couple of years. So it's been a gush of investor money that's come in, right? But I think obviously the pertinent question to think about is, what have these funds done and are they suitable for all investors, right? So let's just unpack this, in various segments. So one is obviously, when you just think about it, from the start of 2020, just in the previous period to COVID, the number of sectoral thematic funds that existed at that point of time, as opposed to today, it was much smaller numbers. So if we just look at the number, then it was about in the ballpark of about 85 funds. And from those 85 funds, if I just purely look at point-to-point returns, right, when we think about how these funds done, from those 85, almost 2/3 of these on a point-to-point performance from 1st January 2020 up until 31st of July 2025, 2/3 of these have outperformed, say, the BSE 500 total return index. So at the face of it, it looks great, right? That, you had a good 2/3 chance of getting a sector or theme right amongst the fund bouquet, and you would have made money obviously over a reasonably long time period, about 5.5 years, in which you've seen several market cycles, including the COVID crash of Feb and March 2020, right? But if you break this down, right, so the funds have done what they've done. Have investors actually made money? I think that's a question that's very important to ponder over, because what we have seen, and this is not just an India phenomenon, investors tend to do a lot of revenue mirror driving when it comes to it, because sectors and themes tend to have extremely lumpy returns, right? So even if I look at this last 5.5 year period, different sectors or themes have come to the fore over that period of time. If I can just break that down, if you think about 2020, 2021, technology was amongst the best performing sectors at that point. Healthcare did really well in 2020 and 24. In the more recent times, you've had the PSU pack, or you've had the cap codes. The infrastructure theme sort of do well over the last couple of years. So sectors and themes come to the fore at different points of time, and investors more often than not find it challenging to get this timing right, because it is hard, right? So I think that is the thing that needs to be kept into context when you think about the success rates over a point-to-point period for sectoral thematic funds.
We'll get into that.
Yeah.
But just to delve a little deeper into this 2/3 number, which is quite substantial. If you actually look at the rolling returns of mid-cap funds, you look at the rolling returns of small-cap funds, and of course, this is point-to-point returns. So perhaps the rolling returns will tell you a different story because of the lumpiness of these schemes. But it's not as substantial, right? So the winners in the mid-cap category and the small-cap category are not as substantial. Does that tell you something?
So I think obviously when we're comparing here versus broader market, diversified market benchmark, and when you look at mid caps and small caps, you tend to compare it from the context obviously of that particular capitalization benchmark. So yes, you're right that the success rates have probably been lower. But if I were to compare it against a broader benchmark, if you just think that the BSE 500 was your target segment, then also from a similar lens, you would see that smaller mid caps, significant proportion would have outperformed intuitively. I don't have the number on hand, but yeah.
But that's
but I
right.
think but a very important thing to point here, right? When you even think about two-thirds that have done well. And this is a study they've been doing for many years, where we break down this outperformance of funds on a monthly time series basis, right? You look at which were those best months of performance for a particular fund. And what we found, and this is a staggering number, right? So you're looking at a 67-month period since 1st of Jan. On an average, only 5 months accounted for the entire outperformance of a sector thematic fund versus the broader benchmark. That means if you as an investor were not invested in those 5 months, which is less than even 10% of the time periods, you would have actually underperformed the BSE 500. So it's very, very hard from a timing perspective to get your entry and exit right in sector thematic funds. And the lumpiness comes in from just these 5 great months of returns over a 5.5 year period.
Which is why what you were saying is that you take this with a pinch of salt, because yes, there's been two-thirds of an outperformance, but investors have not made money. And if somebody heard that in isolation, they'd be like, what? Kaustubh, kya bol raha hai? And they would be like, no, that can't be true. But the point is that if your sector benchmark or if your sector fund has dropped 20% in a month, then you'd have had to have the gumption to hold it through that period of tough time, and then ensure that you held while it was going up as well. And you absolutely need to be correct on both counts, right? On the entry and on the exit, more so than any other diversified fund. Do you agree with that?
Oh, absolutely. I think, we all talk about, time in the market versus time in the market. But here, in a sense, for sector thematic funds, if you get the timing wrong, and data has shown us that majority of the investors have actually got their entry wrong into these strategies. I'll just take a classic case of, say, technology. I spoke about 2020, 21. You had, I think, the index run up something in excess of 70% each year, right? So staggering returns in that sort of post-COVID period. But the money that came in all post 21, in 22, 23, when we all know IT has gone through its own challenges. So investors came in looking at, kind of the past returns and said, hey, the sector is doing really well, let me come in. But their experience was actually polar opposite to what the funds. So even if I look at a 5-year print of technology funds, they're actually pretty good CAGRs. But what an average investor in those funds would have made would tell a very, very different story. And I think that is the challenge of getting entry and exit into these sectors. Very, very challenging. I think even the best professional money managers will not try to take binary calls on sectors like, and that's why we think that diversified equity funds are such a huge, huge positive for most investors. You're not taking that binary call in a particular sector or theme, right?
Yeah. So, okay. So a few of the questions that I've asked you and that you've shared data for will actually elucidate these points further. So, Kaustubh, I asked you whether there's a significant deviation between the top performing, the worst performing fund in a particular sector. And some of these become so popular that everybody's got a scheme out, right? Obviously, a financial sector fund, a lot of offerings in that, or thematic fund, or a healthcare thematic fund. There are quite a few options to choose from. So has that been something that you've noticed?
Yeah, absolutely, Alex. I think, I wouldn't leave that only to sector funds, but it probably gets a little more exacerbated in sector funds or thematic funds, purely because, it tends to be a little more concentrated. You might have top heavy names. So depending on the way these active managers would weight, some of the benchmark or off benchmark names, you can have significant divergences in, if I just purely looked at, say, the best performing versus, the absolute bottom of the pack, you can have differences over a 5-year period of as significant as even 10, 12% in, several of these sectors. So the experience for investors, even across funds within a sector theme, can be quite dramatic. And I think that's also kind of underpins the point, not just that it's very, very hard to take exposure, but also how do you take exposure becomes the other question that investors need to think about if they're willing to take that exposure in the first place.
Okay. The other question that I asked was whether passive funds have done better. And for me, I've looked at a few of these sectors, and defense is a prime example where the defense index itself has done significantly better than the actively managed fund.
Yeah, and Alex, this is a very interesting, sort of question to look at why this is the case, right? So if you think about some of the more, obviously indices are constructed. There is a mechanism, the way it's constructed, and the passive will look to mirror that. But, your index heavyweights, and especially for sector themes, you will tend to have very, very heavy index, top heavy names, so your top 5 constituents would typically be in excess of anywhere between 50 to 75%, depending on the sector or the theme. Whereas an active manager will tend to take obviously off benchmark bets or not take sizable exposure to, say an index heavyweight, which is say 25-30% in that index by the virtue of the way it's constructed on, a market capitalization basis, right? So that can lead to two outcomes, right? So one is if it's a very narrow sector and theme, if the top two names in an index do really well. Like for instance, you spoke about the defense index. Obviously, the heavyweights have done very well over the period of time, and the allocation in the index has only gone up. That's where the actives perhaps struggled because they didn't hold that index name in that much of a proportion. But the same can happen on the contrary if the index heavyweights were to underperform over a period of time, right? But in more broader sectors, when I say broader, that there is an opportunity set that lies outside the index heavyweights. Let's take, for example, technology or healthcare. When you look at some of these, you would see that actually the active managers have added a fair bit of alpha because they could have gone into segments, maybe down the capitalization curve or weighted some of the index names differently.
Yeah.
So I think it needs to be looked at from the context of that and not just painting it in an active versus passive debate because it could be very different exposures that you could gain depending on the narrowness or the broad sort of sector theme that comes into play.
So we have a few more minutes to talk about these very important subjects, so we'll have to run through it. The important question, has a SIP approach worked? So a SIP approach in thematic sector funds?
Right. Okay, now I'm going to play a little bit of devil's advocate because obviously we love SIPs, right? Yeah. And it's been the backbone of investor sort of investing. But when I think about a SIP approach with sector thematic funds, while it's probably still the best way to take exposure to sector thematics because we spoke about the lumpy nature, so you avoid the timing risk. But when you look at the SIP returns of sector thematics, because of this lumpiness, and you compare it with some of the well-managed diversified equity funds, you'd actually see that the SIP returns are almost tending towards some of these diversified equity funds, purely because you've had this crazy months of volatility in between, so you'd come at different varying entry points, whereas the diversified equity fund will have a much more balanced approach, and you'll have much more sort of better outcomes from your SIP, even though the point-to-point returns for that sector or theme look much better, say on a 5-year basis, right? So I think that really brings to point that how do you take exposure? And to my mind, like I said, probably most investors are better off just sipping into diversified equity funds. Your outcome won't be too different from a sector thematic. You only take exposure to a sector thematic if you really want to express a very specific view where you can get the entry and exit right, because that is very crucial.
Yeah,
right? You need
tactical.
You come in early, and get out, when it's at a high.
Yeah, so tactical allocation. Is there a way to understand whether people have made money in sector thematic funds? You've actually identified investor return. How do you get that, and what does it tell you?
Yeah, so the investor return is a very powerful study which tells you that what is the return that an average rupee invested in the fund has made, right? Because if a fund, say for instance, returns 30% over a 5-year period, only the investor who came in on day 1 and stayed the end of day 5 will make that 30% return. But like I said, investors come at different points of time. They often come after the good time for a fund has already delivered its returns, and they actually get suboptimal returns. So what we saw, and this is again a global phenomena, that investor returns in very narrow sector thematic funds actually is significant. So if you look at some of the popular funds that have done well, and this is data which is slightly dated, which is end of last year, so December 24. But when you see two funds, we looked at a technology fund and infrastructure fund, the investor gap. So the fund, for instance, a technology fund did about close to 30% CAGR over a 5-year period. But the average investor made only 17.8%. So that's a staggering 12% sort of gap between the fund return and the investor return. In fact, in the infrastructure fund, it was almost 17% gap on a 35%. So half the investor returns were lost because investors just made poorly timed entry and exits, and they lost most of the fund returns. So while the fund returns on paper look great, investors haven't had, or large part of investors haven't had the same experience in these strategies.
And so the trick, therefore, is to stay invested and also to time your exit, as hard as that is to do. Kaustubh, thanks so much for joining me today. Important data points that we've laid out, and hopefully that'll help people make the right investment decisions. Thanks so much for taking the time.
Thank you.
And that brings us to the end of this edition of Your Money Matters. Thanks so much for watching. This is NDTV Profit.